There are three major categories of investment. The first category is anything denominated in a currency. It can be bonds, it can be deposits in a bank, it can be a money market fund, it can be cash in your pocket. And the second category of investments regard items that you buy that don't produce anything, but that you hope someone will pay you more for later on. And the classic case of that is gold. The third category of asset is something that you value based on its what it will produce, what it will deliver. You buy a farm because you expect a certain amount of corn or soybeans or cotton or whatever it may be to come your way every year. And you decide how much you pay based on how much you think the asset itself will deliver over time.
Investing in the stock market is a great way to save up for those big things in life. Your kids' education, the house of your dreams, and of course, your retirement. There are two main ways for you to invest: active investing and passive investing. With passive investing, your money is used to buy shares in a group of companies. This group of companies is called an index. If these companies collectively do well, so will the index, and your money will grow. Because passive investing requires little human intervention, fees are fairly low. However, as passive investing only matches the performance of an index, your investment does not outperform that index. Active investing, on the other hand, means you have a dedicated portfolio manager handling your investment. Active managers want to outperform the index. They use your money to buy shares in companies they predict will do well and avoid companies they think will fail. Your manager will try to seek out good investment opportunities to really make your money grow. The bad news is this doesn't always happen. With active investment, there's room for error, so a lot depends on finding a great manager who can pick investments better than the rest. Because active managers are so hands-on, they also tend to charge more for their services. So what's best for you? If you find the idea of choosing an active manager daunting, passive investing may be the way to go. But if you prefer to risk more to potentially gain more, an active manager may be more your style. A good idea might be to combine both active and passive funds. Striking a balance between the two means you may just get the best of both worlds. By starting to invest early, we'll get your money working for you.
I would say that in terms of the index fund, I would just take a very broad index. I would take the S&P 500 as long as I wasn't putting all my money in at one time. If I were going to put money into a index fund in relatively equal amounts over a 20 or 30-year period, I would pick a fund, and I know Vanguard has very low costs. I'm sure there are a whole bunch of others that do. I just haven't looked at the field. But I would be very careful about the costs involved because all they're doing for you is buying that index. I think that the people who buy those index funds on average will get better results than the people that buy funds that have higher costs attached to them, because it's just a matter of math. If you have a very high percentage of funds being institutionally managed, and a great many institutions charge a lot of money for doing it and others charge a little, they're going to get very similar gross results but different net results. And I recommend to all of you reading John Bogle's written a couple of books in the last 5 years, and I can't give you the titles, but they're very good books, and anybody investing in funds should read those books before investing, or if you've already invested, you still should read the books, and it's all you need to know really about fund investing. So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time, because the very nature of index funds is that you are saying, I think America's business is going to do well over, or reasonably well over, a long period of time, but I don't know enough to pick the winners, and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't, and so on. So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time. As to the criteria as to when you should or shouldn't, I don't think there are any great criteria on that. I don't think price earnings ratio, determines things. I don't think price book ratios, price sales ratios. I don't think there's no single metric I can give you or that anyone else can give you, in my view, that will tell you this is a great time to buy stocks or not to buy stocks or anything of the sort. It just isn't that easy. That's why you go to an index fund, and that's why you buy over a period of time. It isn't that easy. You can't get it by reading a magazine. You can't get it by watching television. You'd love to have something that said, if PEs are 12 or below or some number you buy, and if they're 25 or above you sell. It doesn't work that way. It's a more complex business than that. It couldn't be that easy when you think about it. So if you are buying an index fund, you are protecting yourself against the fact that you don't know the answers to those questions, but that you think you can do well over time without knowing the answers to those questions, as long as you consciously recognize that fact. And I would, if you're a young person and you intend to save a portion of your income over time, I just say just pick out a very broad index, and I would probably use the S&P 500, because I think if you start getting beyond that, you starting to think you should be in small caps this time and large caps that time, or this foreign stock. And as soon as you do that, you're in a game you don't know. You're not equipped to play in all candor. That would be my recommendation. Charlie?
I think his second worry is that common stocks could become so high priced that if you bought index funds, you wouldn't expect to do very well. I didn't think I'd live long enough to think that was likely to happen, but now I think that may happen.
But probably what you're saying there is that they could get to a level and they'd have to be at a sustained level like that for a long time.
They could be there and stay there for a long time.
In which case you might make 3 or 4%. But would there be anything way better than that around under those circumstances anyway? And pass the peanut brittle, please.
Well, in Japan, where something like this happened, the return from owning a nice index over the last 13 years or so is negative. Can something as horrible as that happen here? I mean, is it conceivable? I think the answer is yes.
But the option in Japan, of course, is to have deposits in a bank or own Japanese bonds at somewhere between 0 and 1 or 1.5%. So if rates on everything get very low, which means stocks sell very high, then it just means that you live in a different world than existed 20 or 30 years ago, when generally capital got paid better. Mm-hmm.
I must say that we have very good packaging.
Yeah. We look at it, the criteria for selecting a stock is really the criteria for looking at a business. We are looking for a business we can understand. That means they sell a product that we think we understand, and we understand the nature of their competition, what could go wrong with it over time. And then when we find that business, we try to figure out whether the economics of it, means the earning power over the next 5 or 10 or 15 years, is likely to be good and getting better or poor and getting worse. But we try to evaluate that future stream, and then we try to decide whether we're getting in with some people that we feel comfortable being in with. And then we try to decide what's an appropriate price for what we've seen up to that point. And as I said last year, what we do is simple but not necessarily easy. The checklist that is going through our mind is not very complicated. Knowing what you don't know is important, and sometimes that's not easy. And knowing the future is definitely it's impossible in many cases in our view, and it's difficult in others, and sometimes it's relatively easy, and we're looking for the ones that are relatively easy. And then when you get all through, you have to find it at a price that's interesting to you, and that's very difficult for us now, although there have been periods in the past where it's been a total cinch. And that's what goes through our mind. If you were thinking of buying a service station or a dry cleaning establishment or a convenience store in Omaha to invest your life savings in and run as a business, you think about the same sort of things. You think about the competitive position and what it would look like 5 or 10 years from now and how you were going to run it, who was going to run it for you, and how much you had to pay. And that's exactly what we think of as when we look at a stock, because a stock is nothing other than a piece of a business. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood, and to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And it's conventional practice, and it may, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own 1 stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to, have proper diversification? It'd be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And the truth is, you don't need it. I mean, if you have a really wonderful business, is very well protected against the vicissitudes of the economy over time and competition. I mean, we're talking about businesses that are resistant to effective competition, and 3 of those will be better than 100 average businesses, and they'll be safer, incidentally. I mean, there is less risk in owning 3 easy to identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that. But I can assure you that I would rather pick, if I had to bet the next 30 years on the fortunes of my family that would be dependent upon the income from a given group of businesses, I would rather pick 3 businesses from those we own than own a diversified group of 50. Charlie?
Yeah, what he's saying is that much of what is taught in modern corporate finance courses is twaddle.
Do you want to elaborate on that, Charlie?
You cannot believe this stuff. I mean, it's modern portfolio theory, and
it has no utility. But I mean, it will tell you how to do average. But I think anybody can figure out how to do average in 5th grade. I mean, it's just not that difficult. And it's elaborate, and there's lots of little Greek letters and all kinds of things to make you feel that you're in the big leagues. But there is no value added.
I have great difficulty with it because I am something of a student of dementia, and I have
We hang around a lot
and
together.
I can ordinarily classify dementia, on some theory structure of models, but the modern portfolio theory, it involves a type of dementia I just can't even classify. Something very strange is going on.
If you find three wonderful businesses in your life, you'll get very rich. And if you understand them, bad things aren't going to happen to those three. I mean, that's the characteristic of it.
By the way, maybe that's the reason there's so much dementia. If you believe what Warren said, you could teach the whole course in about a week.
Yeah. Yeah, and the high priest wouldn't have any edge over the lay people, and that never sells well.
Right.
Well, I would use the approach that I think I'm using now of trying to search out businesses where I think they're selling at the lowest price relative to the discounted cash they would produce in the future. But if I were working with a small amount of money, the universe would be huge compared to the universe of possible ideas I work with now. You mentioned that 56 to 69 was the best period. Actually, my best period was before that. It was from right after I met Ben Graham in early 1951. But from the end of 1950 through the next 10 years, actually returns averaged about 50% a year. And I think they were 37 points better than the Dow per year, something like that. But I was working with a tiny, tiny, tiny amount of money. And so I would pour through volumes of businesses, and I would find one or two that I could put $10,000 into or $15,000 into that were just ridiculous. They were ridiculously cheap. And obviously, as the money increased, the universe of possible ideas started shrinking dramatically. The times were also better for doing it in that time. But I think if you're working with a small amount of money, with exactly the same background that Charlie and I have, and same ideas, same whatever ability we have, I think you can make very significant sums. But as soon as you start getting the money up into the millions, many millions, the curve on expectable results falls off just dramatically. But that's the nature of it. You've got to, when you get up to things you can put millions of dollars into, you've got a lot of competition looking at that, and they're not looking as I did when I started. When I started, I went through the pages of the manuals page by page. I mean, I probably went through 20,000 pages in the Moody's Industrial, Transportation, Banks, and Finance manuals. And I did it twice. And I actually, looked at every business. I didn't look very hard at some. Well, that's not a practical way to invest tens or hundreds of millions of dollars. So I would say if you're working with a small sum of money and you're really interested in the business and willing to do the work, you will find something. If you were, there's no question about it in my mind. You will find some things that promise very large returns compared to what we will be able to deliver with large sums of money. Charlie?
Well, yeah, I think that's right. A brilliant man who can't get any money from other people and is working with a very small sum probably should work in very obscure stocks, searching out unusual, mispriced opportunities. But, that's such a small world. It may be a way for one person to come up, but it's a long slog.
Yeah, most smart people, unfortunately, in Wall Street figure that they can make a lot more money, a lot easier, just by one way or another, getting an override on other people's money or delivering services in some way that people. And the monetization of hope and greed, is a way to make a huge amount of money. And right now, it's just take hedge funds. I mean, I've had calls from a couple of friends in the last month that don't know anything about. investing money. They've been unsuccessful and everything else. And, one of them called me the other day and said, well, I'm forming a small hedge fund, 125 million he was talking about. Like the thought that since it was only 125 million, maybe we ought to put in 10 million or something of the sort. I mean, if you looked at this fellow's Schedule D on his 1040 for the last 20 years, you'd think he ought to be mowing lawns. But he may get his 125 million. I mean, and it's just astounding to me how willing people are during a bull market just to toss money around because they think it's easy. And of course that's what they felt about internet stocks a few years ago. They'll think about something else next year too. But the biggest money made in Wall Street in recent years has not been made by great performance, but it's been made by great promotion, basically. Charlie, do you have anything?
Well, I would state it even more strongly. I think the current scene is obscene. I think there's too much mania. There's too much chasing after easy money. There's too much misleading sales material about investments. There's too much on the television emphasizing speculation in stocks.
Let's say you'd taken that $10,000 and you'd listened to the prophets of doom and gloom around you, and instead you'd use the $10,000 to buy gold. Look in your safe deposit box, and you'd have your 300 ounces of gold, and you could look at it, and you could fondle it, and you could, whatever you wanted to do with it. But it didn't produce anything. It was never going to produce anything. And what would you have today? You would have 300 ounces of gold, just like you had in March of 1942, and it would be worth approximately $400,000. So if you decided to go with a non-productive asset, gold, instead of a productive asset, which actually was earning more money and reinvesting and paying dividends and maybe purchasing stock, whatever it might be, you would now have over 100 times the value of what you would have had with a non-productive asset. In other words, for every dollar you have made in American business, you'd have less than a penny of gain by buying in the store of value, which people tell you to run to every time you get scared by the headlines or something of the sort.
When I look at real estate or stocks, real estate is just easier to evaluate. You comps, cash flow, and replacement cost. It just seems an easier game than the equities market, provided that you don't use
real estate.
Yeah, real estate.
The trouble with real estate is everybody else understands it, and the people who you're dealing with and competing with it, they've specialized in a little 12 blocks or a little industry. They know more about the industry than you do. So, and then you've got a lot of bullshitters and liars and brokers. So it's not a bit easy. It's not a bit easy. The trouble is, if it's easy, all these people, a whole bunch of ethnics that love real estate. Asians, Hasidic Jews, Indians from India, they all love real estate. They're smart people. And they know everybody and they know the tricks and getting this. You don't even see the good offerings in real estate. They show that the big investors are dealing. It's not an easy game to play from a beginner's point of view, real estate. Whereas stocks, you're equal with everybody if you're smart. In real estate, you don't even see the opportunities when you're a young person starting out. They go to others. The stock market's always open. It's in venture capital. Sequoia sees the good stuff. You could open an office, Joe Schmo, venture capitalists, startups come to me that starved to death. You got to figure out what your competitive position is and what you're choosing. Real estate has a lot of difficulties. And those Patels from India that buy all the motels, they know more about motels than you do. They live in the goddamn motel with their family. They pay no income taxes. They don't pay much in workers' compensation. And every dime they get, they fix up the thing and buy another motel. You want to compete with the Patels? Not I.
I never know what markets are going to do. There's never been a time in my life when I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even. I never felt that I knew it, and I've never felt it was important. I will say that in 10 or 20 or 30 years, I think stocks will be a lot higher than they are now.
You know, I know you look at things like that, but I also know that you look at stocks and try to decide if they're fairly valued, if they're overvalued, if they're looking cheap at this point. And we have been waiting for a correction for an awfully long time. That's finally come. Do stocks look cheaper to you, just based on where we've come?
Well, anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news in terms of anything I buy. But you know, stocks are going to go down. You could probably look it up as to what percent of the days of the, since I was born, they've gone down, and maybe it'd be 30% or something like that. And you can't predict what stocks will do, but in the short run. But you can predict that American business will do well over time. And just take the 20th century. Stocks went from 66, the Dow average, 66 to 11,497, and you were getting 3 times as much in dividends as the whole average was selling for at the start. And you had 2 world wars, and you had a Great Depression, flu epidemics, all kinds of things. American business will do fine over time, and if you own a piece of it, and if you don't beat yourself, the only person that can cause you to get a bad result in stocks is yourself.
Yeah, unfortunately, that's the biggest problem, is trying to fight yourself in some of these situations.
Yeah.
Have you been buying more stocks lately just because prices have come down? Have you upped your percentages and other things just
We're
because?
almost always a buyer of stocks. So we have bought more stocks since the end of the year. But we earned 17 and a fraction billion last year, and we had our float go up 4 billion, which is additional money available. And so we're almost always a buyer of stocks. And we're a more aggressive buyer when they're going down. I mean, I feel much better when they're going down, but it's hard to think of very many months when we haven't been a net buyer of stocks.
A dividend is a payment shareholders receive from a company's earnings. When a company is profitable, management can choose to reinvest profits to help grow the business or distribute those profits to shareholders in the form of dividends. Dividends come in several forms, but the most common is cash, which is deposited into shareholders' investment accounts. For example, if a company declares a 30-cent dividend and you own 100 shares, you'll receive $30. Typically, mature companies with strong cash flows are more likely to pay dividends. Many investors seek the income associated with dividends and often view them as a sign of strength and positive expectations for future earnings. Companies often pay dividends quarterly. However, some pay semi-annually or annually. Keep in mind, companies aren't obligated to pay a dividend and can reduce or stop paying it at any time. You should also be aware that simply owning a stock on the day its dividend is paid doesn't necessarily mean you'll receive the dividend. You must be a shareholder earlier on what's called the record date. Because stock transactions take a few days to clear, and to ensure the accurate allocation of dividends, there is a cutoff prior to the record date called the ex-dividend date. Those who buy the stock on or after the ex-dividend date are not eligible to receive the upcoming dividend. The important thing to remember is that you typically need to purchase a stock at least a couple days before the record date to officially own it in time to be eligible to receive the dividend. The number of days between the record date and the day the dividend is paid varies from company to company, but is often between 1 and 6 weeks. Instead of receiving dividends as cash, you can also opt for an automatic dividend reinvestment plan, or DRIP, for eligible securities. With a DRIP, dividends are automatically used to purchase additional shares. This allows investors to accumulate more shares over time and can potentially compound returns, but also increases portfolio risk. Some investors specifically seek out and invest in dividend-paying stocks. Dividend stocks can provide income and potentially enhance a portfolio's overall returns. Since 1926, the U.S. economy has undergone many bull and bear market cycles. However, the income return received from dividends has been relatively consistent during this time period. Investors can measure the percentage return from dividend income using dividend yield. Yield is the percent return of an asset paid over 1 year. For dividend stocks, the yield is the sum of the last 4 quarterly dividends divided by the price of the stock, multiplied by 100. Let's look at an example. Say there's a $30 stock that over the past 4 quarters paid dividends totaling 78 cents per share. This means the stock has dividend yield of 2.6%. Dividend yield essentially tells you how much return you're getting for the price of the stock. It also allows you to compare the dividends of stocks with different prices, as well as other interest-bearing securities like bonds or CDs. For example, if investors were faced with the decision to purchase a bond yielding 1.5% or a stock with a dividend yield of 2.6%, they may potentially choose the latter. In addition to potentially higher yield, many investors look for consistent and growing dividends over time as an indication of company health and likelihood of paying future dividends. Although dividend stocks have many benefits, they do have some unique risks. Because they're often considered an alternative to interest-paying securities, dividend stocks are vulnerable to changes in interest rates. In a rising rate environment, investors might sell dividend stocks and shift money into other securities, yielding a higher return. It's also important to remember that dividends aren't guaranteed. Companies that pay unusually high dividends may not be able to sustain them, and if dividends are cut, it might send the stock price tumbling. Despite these risks, dividend-paying stocks tend to provide income while still allowing for the potential of stock price appreciation.
It's the process in which an asset's earnings from either interest, capital gains, or dividends are reinvested in order to generate additional earnings over time. This creates exponential growth, as the investment will generate earnings from both its initial principal and all the previously accumulated earnings. The best way to visualize this is as a snowball rolling down a hill. It may start small, but as it rolls, it picks up more snow, making it even larger, allowing it to pick up even more snow, eventually growing the snowball to a significant size. This is the same with investing. The larger amount invested, the more earning power it will generate, which you can reinvest to increase earning power even more, and so on. This fact shows why staying invested and reinvesting earnings is crucial to see the exponential growth from compounding. However, the most important factor is time. In fact, the compounding effect gets far more extreme the longer you can keep it going. Time is everything when it comes to compounding. That's why you should start investing as early as you can. But even if you're older, the important thing is to just start so the snowball can get rolling. So rule number 1 is that you need to beat inflation. The best way to do this is to invest in productive assets. This is something with the ability to generate profits and cash flow, such as a business, farm, real estate, etc. I practice a dividend investing strategy by investing in high-quality companies that consistently increase their dividend payouts for long periods of time. This fact is why I love a dividend investing strategy. You are generating significant cash flow without having to sell any of your stock. Even if you took out the dividend to pay for expenses, you'd still have dividend raises and the internal compounding effect of owning the company.